Okay, let's have a look now at what happens in year 4. Remember from my bell curve that by year 4 we've started to hit the downward slope. Things are starting to reverse. We've run out of tax deductions by the end of year 3. So we still need to add back the accounting depreciation expense because it's not tax deductible. So let's do my current tax liability calc. Again, assume a profit. Let's say it's $150,000. I add back the accounting depreciation expense of $3,000. I've got no tax depreciation deductions to claim in year 4, so my taxable income is $153,000. So at 30%, my current tax liability is $45,900. Debit income tax expense, credit current tax liability, $45,900. Let's now look at our deferred tax liability. My taxable temporary difference is $9,000. This is the beginning of the reversal of the temporary difference. Now, it might be tempting to put the debit entry that we're going to record in a moment to the deferred tax asset account. But remember what our bell curves show. By the time we get to year 4, it's just the reversal of the temporary difference that we had recorded in our deferred tax liability account. So our deferred tax liability at the end of year 4 is $2,700 because we've got a carrying amount of $9,000. And that's because we've got a cost of $21,000 and then we've got 4 years worth of depreciation at $3,000. So $12,000 in accumulated depreciation taken away from our cost of $21,000, the carrying amount is $9,000. So we've got a deferred tax liability of $2,700. The opening balance was $3,600 in the deferred tax liability account. Remember, that's what it was at the end of year 3. But now at the end of year 4, that liability is only $2,700. So we've got a $900 debit movement. So you can see there my journal entry has a debit to the DTL account of $900 and a credit to income tax expense. So that's the deferred tax movement for year 4. The debit goes to the DTL account because that temporary difference for the machine is starting to reverse. Okay, I'm now going to jump the gun and say, let's have a look at what happens in year 7. Remember, year 7 is the last year of the machine's useful life for accounting purposes. My current tax liability calc, again, an assumed profit of $160,000, add back that $3,000 in accounting depreciation expense. Tax deductions, well, they're long gone, so my taxable income is $163,000. I've got a current tax liability of $48,900. Debit income tax expense, credit current tax liability, $48,900 being our current tax liability for year 7. What about my deferred tax liability at the end of year 7? Well, I'm now in equilibrium. My carrying amount and my tax base are both 0 because the asset is fully depreciated for accounting and all tax deductions have been claimed, so got 0 tax base as well. So the deferred tax liability is 0. The temporary difference is all gone by the end of year 7. Remember what that bell curve looked like. So a 0 deferred tax liability at the end of year 7, but the opening balance that would have carried forward from the end of year 6 would have been $900. Therefore, my movement for the year is $900 debit. So debit DTL, credit income tax expense, and that's the deferred tax movement for year 7. So for accounting, we've expensed $21,000, and for tax, we've deducted $21,000 in depreciation deductions. So the same totals have hit both books. There's no more temporary difference.